from a market practitioner standpoint, I think what the Fed did at the end of the first quarter was brilliant. They, after trying to get at the liquidity issue with an axe, cutting the discount rate and really having no effect other than devaluing the dollar and forcing the price of oil through the roof. They really in the first quarter started to key in on what the issues were. I know they talked to a lot of market participants, got the input, and I think they really dialed in what they were doing in the right way, whether it was with opening the window to the investment banks, taking back different collateral. They seem to have solved the liquidity crisis that was really driving the problems, kind of the fallout of subprime, where every structured asset class, every counterparty was no longer reliable and in doubt. And that's allowing the buyers to adjust and really determine where there is real fundamental value and go in and be able to buy that fundamental value. So I think we're going to see a stabilization. But, and this is a critical point, the cost of capital is higher today than it was a year ago, and its ability to come down is going to be slowed as a result of these things. I don't think you'll see investment banks and commercial banks running with the same leverage in 2009 that they had in 2006. And you can kind of do the math on what that deleveraging is, but it means, presumably trillions of dollars of assets that will need to be sold on a organized basis over the next 24 months to get them to their new targeted leverage ratios. Hedge funds will not be running with the same amount of leverage that they ran before. So the cost of capital is going to be higher. Certainly the SIVs aren't coming back anytime soon, which provided an enormous amount of AAA capacity that was low-cost financing that was fueling asset prices. That's going to be gone. So I think we're going to be looking at a world where there will be a higher cost of capital for a intermediate period that is not a technical period, that needs to still be reflected in asset prices. So meaning not the liquidity dislocation, but a recalibrating. And then second, I think where that recalibration will come in is going to be dependent over the next 12 months on the fundamentals. And none of us really know whether we're in a recession now or whether we're going into a recession, but all of us who operate in the markets can look at corporate earnings, individual investments that we have, and see that clearly the momentum and growth around those is a much different picture today than it was in July of last year when this first started. And I think the next 6 months are going to be really critical. I think when we start to see the impact on those earnings, we'll have a much better idea whether we have a recession, and if so, to the extent. And when you talk to smart people in the market, you get a surprising broad range of opinions on where it can be, and I think that that leads to uncertainty, which creates opportunity and risk, and I don't see that risk going away in the month of April the way the markets seem to have thought. I think it's going to play out over 6 months.
Right.